Hey guys, welcome to this video. Will Sebastian here. Don't forget to get my free training underneath. You'll learn an awful lot. I just thought as we close the markets out on this Friday, it's currently 5:30 GMT time, the 15th of December. I know we're all excited for Christmas if you celebrate it in 10 days. So I'll be teetering around next week to finish up before we get to that point, and I'll wish everyone a happy holiday then. But given what has occurred this week, given the market volatility we've seen, given everything that's gone on, especially in regards to comments from the Fed, okay, and the FOMC conference that took place yesterday, we've seen a lot of rhetoric around slight sort of what looks like improvements in the outlook for the global economy and the US economy. And really, what that has meant is quite clear. And it's really a brilliant time if you're someone who wants to understand sentiment and its effect on markets. Then this is a great time to be looking at it, because if I go to the weekly, you can see you've got various candle wicks pulling you up. If I go to the daily, it's even worse. Okay, the retracement is hardly anything, and you pull straight back up. Now, what makes this occur? Okay, well, number one is people buying. Okay, of course, that's why prices rise. It's because, well, investors or traders get long. Okay, I'm on my laptop, that's why it's a bit tappy. Investors and traders get long at different points in the market, but normally it's when you start to get the fear removed and people then say, you know what, I'm not so worried anymore. Of course, you had global tensions escalate around this point. That's why you get this big fall in the markets through October. Okay, that had come off the back of a fall since the summer. The market had been oscillating, pulling you in a downtrend to the downside. Finally, it had enough just as it came about your 200 MA, and you rocket fired up. So plainly, the reason for that is because people bought, obviously. But why? Okay, it's for the reason. Okay, and the reason is sentiment improves. Okay, so that's positivity, and this takes on many forms. But generally speaking, when you're looking at stock markets, indexes, equity markets, okay, it's about the positive outlook. It doesn't necessarily have to be that there's positive results as such. Okay, you don't have to have inflation readings every single time, or retail sales, or whatever it may be. Okay, it's just the rhetoric, the speech, and what is said is the main thing that helps, because it doesn't actually have to be the case that anything has happened. It just has to be the case that people think it will happen. And that's why they buy on the sentiment improving. Okay, so plainly, the reason why price factually goes up is because people buy. We know that because essentially there's necessity there. If you're buying and buying and buying, the bids go up and up and up, just like it would in an auction. If you imagine this as an auction and people are buying contracts into the US100, the NASDAQ, they would all be putting their little paddles up in the room saying, I want to buy, I want to buy, I want to buy. And as we all know, okay, when you get to that point, what happens is price goes up because people want to buy more and more and more. And as they buy more and more and more, the market tilts up. So everyone who is investing in any global index market or stock market, whatever you want to call it, will be one of those people. They're deciding at every single point, is it worth me buying now? And then they put their paddles up and they say, yes, it's worth me buying. And that draws the price higher and higher and higher, as we've seen. Now, it eventually comes to a point where the paddles go down slightly and the price falls, and people say, you know what, perhaps I don't want to buy this. Okay. And that is why the price drops, which you saw rebounded with people putting the paddles up again. And they want to buy and they want to buy and they want to buy. Now, what do you think happens to the people who are buying nearer the top? Do you think they're in the same position as those who got in early at a better deal lower down? Or do you think they're exposing themselves and they're a bit too late? Okay, they're the second mouse to the cheese, if you like. And the answer is absolutely that. Okay, if you've got to the point where you're buying at the sort of end of a rally, if you like, then clearly you aren't getting the best price, and you're far more exposed to a loss than someone who bought much earlier on. Now, this is another question for you. Who do you think is buying early on? Do you think it's people who are making money, or do you think it's people who are losing money? Now, quite evidently, it's going to be people who are making money. It's going to be those guys who are savvy enough to say, okay, I want to get long early so I can catch the price move. And as the sentiment continues to improve, as the rhetoric from central bank governing bodies in various economic jurisdictions changes, it feeds into the market and it feeds into that buying, and people's paddles go up as more speech comes out because they're looking for opportunity. If anyone is investing in anything in an auction house, similarly, they're looking for opportunity. They're looking for that chance that they might make money on their investment. And that's why they get more desperate and more desperate. So the longer the price comes up, it's because there's more of that desperation feeding into the market. And you can see 1, 2, 3, 4, 5, 6, 7 weeks or so, we've come up from 14,000 without a drop to 16,700. So 2,700 points with no drop. Okay, when did the last time, that sort of happened, where you got 12,700 there to 15,200 there? Okay, 2,500 points until you finally get a red candle. All right, so more or less, we've gone a longer way. Now, you can see ultimately what occurs after these extreme rallies. And again, this was on that positive sentiment again. Okay, this is where people said, all right, well, I don't think there's going to be inflation problems or recession problems, but that's why the price fell from up here, because you had all the rhetoric around it and you slowly started to get results feeding that way economically. And that's why the price fell. So weeks and weeks and weeks and weeks up. And you've now got the chance to, instead of being a paddle thrower or putting your paddle up, suddenly you can flip and you can get on the other side of the market. And you can be one of those guys who has their paddle down. And actually, you can be one of those guys who's selling at the auction house, who's selling their product. Now, you have to remember there's every chance, and it's more than possible, that you may get higher than this high. But the secret to trading successfully is understanding that if you do get higher, you're going to have to deal with it. You're going to have some sort of risk management plans that are going to stop you getting wasted, because you've already come a considerable way, just like you had when you fell from here. And you would expect another fall to be fairly high velocity, because if you've already come up so much, okay, and it's so priced into the market, what normally comes after that is a far larger retracement later on. So don't pretend you can't get higher than this high. That's not what I'm saying whatsoever. I'm saying that at this point, I would rather be one of those people who is better placed. If you're buying now, you aren't better placed. You were down here, but not up here, because you're simply getting a worse price than you could have. But instead of buying, you could be short. Okay, now let's change it. Who do you think is better off? Do you think it's the people selling up there, or the people selling there, or the people selling here? Okay, clearly, the later on in the move, the better positioned you are, because you've got larger room for a fall. So it's the complete flip side of what I was saying. With the long side, if you bought earlier, you're better off. And generally, that's what professional traders, institutions, anyone who's making money out of financial markets, buying and selling, whatever it is, will do. And it's the same for people buying things at auction. Okay, dealers, if you like, people who are trying to make money off those antiques. The ones who always make money are the ones who are buying low when the opportunity is there and ultimately selling high. Now, the point they're at is one of those points where they can sell high and they can reel a larger profit. Okay. And by selling high, I do mean simply liquidating their longs. They don't even have to short the market. They're still technically short if they're exiting those longs. And I highly expect them to, and I will too. I'm short biased at the moment. Thanks for watching. Hope that helps. Follow me and subscribe for more detailed posts and get my free training underneath. See you in the next one.